Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 226. Terrible days continue. 10th day today, where stocks are getting smashed, and there seems to be no end to this right now. Uh, Major indices are down between 15 to 30% already from the top, and we essentially continue to fall every day after the western markets fall, and then the Asian markets follow through, and we fall again after that. At some point of time we will come to some at least a intermediate bottom. I'm hoping that that may be tomorrow, where some buying may emerge out of the current valuations that may have come forth, and some of the liquidity that may be on the sidelines may jump in. But it does seem a little bleak that we will uh, go back up very soon. I think there can be a bounce, but we will need significant consolidation after we reach some intermediate bottom to really build back a base for this market to go further up. As you can see on the screen, there is virtually no green. IT stocks, pharma, FMCG, the three defensives were the least hit, but the major damage happened today in PSU banks, metal stocks, commodity stocks, energy stocks. Essentially no place to hide. Small caps hit more than large caps, and the returns from 1 week, 1 month, 3 months, pretty much all red, barring very few cases, and it seems to be one of the sort of a worst starts to any financial year we've had in many years. This is coming on the back of two reasonably strong years, and we'll see in today's episode why we need not worry too much about what's happening in the market right now. Overall, broader indices 1.4% down, small cap index 1.8% down, mid and small cap index, Nifty 1.9%, CNX 500 1.9%, CNX 200 1.9%, Nifty next 50 2%. So small caps actually made a comeback in the last 1 hour. They were down 2.5% at one point. In terms of weekend investing strategies, again hit reasonably badly. ATH least hit because it had reached a cash position of almost 50% last week, minus 0.779. NG 50/50 also not so performing so well yet. Gold has not yet picked up against the market, which it usually does. It could be delayed. I'm hoping that it is delayed and not the case that it does not go up. LTCNX 200 -1, ATH -1, and others between 2 and 3.5%. NNF 10 being exceptionally hit hard on the back of Adani stocks getting hit hard. We were enjoying the Adani rally while it was on, and now of course we are having to bear some brunt of that fall. All in all, not good days to remember, but from a practical perspective, from a realistic perspective, this is part of the part of what one can expect in the markets from time to time. And we'll show you that data shortly. Within today's mayhem, there were spots of bright spots of sparkle where stocks were going up. So KRBL up 15%. There was some news about some tax case getting resolved, and company will receive some large amounts. Indo count up 15%, Avanti Feeds up 13%, India Bull Housing after getting smashed yesterday up 7%, and Network 18 recovering from a recent smash plus 6%. PNB was very poorly hit, very badly hit, minus 14% on PNB. Adani Green continues to get hit, minus 8%. Jindal Hisar now down 7. Praj Industries, PB Fintech also down 7%. So all the new age stocks also getting hammered. Zomato is near 50 odd rupees. Paytm is almost near its all-time weekly lows. Nykaa is at its low. You name it, and they've had it on the chin. So coming to today's topic, how have markets done after past falls? So what we have done is taken the last 20 odd years and seen where did market hit a 52-week low first in any intermediate cycle. So March 13, 2001, it hit a yearly low at 1124. Then again it may have jumped up and come down again and hit a near yearly low in April 1, then September 1, then there was a low at October 2. Then for 6 years market did not hit a 52-week low. It happened in July 2008 during the GFC, then again in October 8, then again for 3 years no lows, August 2011, November 11, December 11. So it will come in succession, and then again for about 4 years no lows, again the next one in September 15, January 16, Feb 16, and then again for 4 years no lows, March 2020 the COVID fall, and March 23 COVID fall. And now we are nearing a 52-week low on Nifty again at 15,808, about 2 years after this last one. So this is basically some of the instances where Nifty, I'm repeating this again, where Nifty hit a 52-week low. So wherever it may have gone, it is hitting a 52-week low, and we want to see what happened 1 year later, 2 years later, and 3 years later. So imagine if today's situation, where we are near a 52-week low, or maybe slightly away from it, where we may be on average a year, 2 years, or 3 years later. Although this is not exact science that this instance will repeat, but over a span of 20 years and over a span of 15 such instances in the past, we will definitely get some idea. So March 2001, 1 year later, was up virtually flat. So 2001, all the instances, 1 year later you didn't make money. 2 years later, this was still negative. If you bought in March 2001, if you bought in April 2001, you were still down 12%. But in September 2001, had you bought it, you would have been up 37% 2 years later. And 3 years later, in all cases, you were up approximately 60 odd percent absolute returns from where you started. So this was 2001. In October 2002, Nifty was at a 52-week low at 950 odd. 1 year later, we are up 60%. 2 years later, we are up 88%. 3 years later, 153%. So very good point to have bought here. During the GFC, July 2008, if you bought, 1 year later, you were still up 11%. 2 years, 34%. 3 years, 44%. Still quite good given the extent of damage that happened after July 2008. From nearly the bottom of the GFC crisis, I think Nifty went to about 2300, so not near the bottom, but still nearer to the time at which the index bottomed. You would have been up 40% within a year, 71% in 2 years, and 32% in 3 years. So there was a drop in the third year. August 2011, no change for 1 year. 2 years later, you would be at 9%. 3 years later, you were at plus 48%. And for all the 2011s, basically the third year remains robust. November 11, if you bought, 3 years later you were up plus 80. December 11 you bought, 3 years later you were plus 73. September 2015, 1 year later 14%, 2 years 29, 3 years 51. January and February 2016, double digits, low double digits first year, 40 odd percent second year, and 43 and 51% at the end of third year. March 2020, COVID fall, 44% within 1 year, 56% in 2 years. March 23rd, just a matter of 14 more days, index dropped from 10,451 to 7,613, a massive drop. You would be up 94% in 1 year and 126% in 2 years, and third year is awaited. So essentially what this is telling you is that Nifty, whenever it is hitting a yearly low, is a very high probability that you will do very well at least in 2 to 3 years. 1 year we've had several instances where it was flat, but even the average over the 1 year is quite good. It is at least in double digits. And 2 years later, you have only 2 instances where you did not make money in 2 years. And in 3 years, there was no instance where you made less than 31%. So the outcome from investing at Nifty 52-week lows has historically been very, very good. Again, I want to point out that this does not guarantee what happens over the next 1, 2 or 3 years, but history often repeats, or at least rhymes, and this is the index returns. And if you have a capable strategy, the returns are going to be much, much more than this. So, this is sort of the base market returns that I'm talking about. So that was the data. Now, also significant number of people are getting a bit panicked, and I'm not saying that the situation is not difficult. It is tough. What I want to convey to you is that this is the nature of the market. I mean, we have dropped about 15% on Nifty, or slightly more than that maybe after today. And we have seen 65% drop in 2008. We've seen 35% drop in 2000 March. So this will happen, and we will have to deal with it. Also, markets will not continue to go down. I mean, just 2 years back, we had a 35% drop and market came back up very strongly. Maybe it will not come back up as strongly as that. It may consolidate for a year or two. It may happen, but that is no reason to get sort of demoralized in the short term. I mean, this is a long-term game. 3 to 5 years is typically where one cycle will play out. So you need to, play out a cycle. Another sort of insight that I would like to share with you is that what we have seen, and it has happened in my own portfolios also, and several weekend investors also have seen it now, that time and again market is giving us the important lesson of staying in the market. So staying or spending time in the market is very important, because it is very difficult to time the market in and out. You may think that we can get out and then get in easily. It usually does not happen. What usually will happen is that people who quit the market will rejoin at the highs of the next swing, because it is very difficult to pull the trigger and buy again, while the market is dropping, if you don't really have a strategy to get in. Because every time you get in, you will either see that the stock has already gone to 100 and now it is 130, how can I buy this? Or it is dropping, it was at 200 and now it is 120, you may think, why should I buy it, let it stabilize, so on and so forth. And usually that causes us to miss the bus. So most people will get out in panic, and they will join once the market has again reflated to higher levels, and by that time it may again be so late. So every time they will have a hit in each cycle and they'll never make money. So those who came in let's say the Modi wave of 2014 and maybe entered at highs, they may not have made money in 15, but in 16, 17 they made a lot of money. Those who came in at the small cap rally in 2017 highs, they did not make money in 2018. In fact, they lost money during 18. But in 19, 20, 21, they made money. And similarly, those who have come in at the fag end of this 21 rally may not make money this year, may lose some, but over the next couple of years, you will make money. But you will need to be associated or you need to stay in with a strategy, or stay into the market, stay into index funds, or whatever you may be doing. So with each swing, you will get better. And running away from the market is no solution, because you need to be with the market. I mean, whatever profession, business you may be doing, if you run away from equity, where will you get returns from? So, but at the other opposite end, a lot of people who got overconfident about their trading or strategies or whatever may have chucked their jobs, or maybe thinking of chucking their jobs and running it full time. And I've seen it time and again during my career, during 2001 rush, during 2008, time and again traders give up their jobs, come to the market thinking that they can run this full time. Some are very successful, but most are not. And this decision of switching from your job to full-time trading should be done very, very carefully, and only if you are able to do well during bad markets also, only then you should do that switch. Another insight I want to share with you is that small cap index, after having dropped this about 25-30% already now, is at the same place where it was at the end of 2017. So about 4.5 years of no performance on the small cap index. But that does not mean that small cap strategies have not done well. This is the small cap strategies performance, MI25 performance and MI35 performance. So if we see this point, maybe it was fag end of 2018, so let's not take FY18. But FY19 you had a loss, FY20 you had a loss, FY21 you made up much more than what you lost and were in nice stead. FY22 also you made very handsome figures of 45%. So 100%, and on top of that 45% or 50% actually makes your capital go from 100 to 300. So despite these two negative years, you would have made money. Now see, the index, it was down 13%, then down 41%, plus 117, plus 35, and now down another sort of 17, maybe 12% since financial year. So that did not make any money over this 4.5 years. But strategies did, because strategies are able to outperform the index in good years, and and the drawdowns can be lower than the index at times over a period of time. So it may not happen in the short term, but over a medium term that will happen. So my point is that even if index has not moved, like this instance, if you see 2008 till 2017, for 9 years there was no new high on the small cap index. But that does not mean that small cap strategies are not having new highs. Small cap strategies are doing very well in that time period, maybe like 3-4 times from the original capital they have gone in that period. So you must have a robust strategy, whether it is following somebody or taking research from elsewhere or doing your own thing. But you can definitely outperform the index in a big way. So don't worry too much about index net not being gaining. Your strategies will gain. The only two things that will help you gain is, on the upside you need to outperform the index, and on the downside you need to outperform the index. These two can come together, then really it can create magic. One more insight from the markets: while tech stocks are crashing, cryptos are crashing as well. There seems to be a very good correlation between these two asset classes, and all the talk about cryptos being a inflation hedge or a contra to equity, those myths have been busted really badly. And a stable coin called Terra has just lost 99% of its value. So the stability of stable coins or crypto coins is there for everybody to see. I don't know much about this particular instance, so I will not dive deeper into it, but this is definitely something that stable coin buyers were not expecting. So be sure that you don't over allocate to any asset class. I continuously say, while equities are great returns, do not overexpose yourself to equity. Keep your equity exposure limited. Distribute your exposure across asset classes. be it real estate, be it gold, be it debt, be it crypto, be it some REITs, be it equity. Definitely not have all eggs in one basket, because you never know what will happen. That is for sure. I mean, regardless of whatever anybody may say, how your country's economics may work. Now look at what is happening in Sri Lanka. Look at what is happening in Nepal. Look at what is happening in Turkey. Look at what is happening in Russia. I mean, these are large countries, and who knows? Something bad may happen someday to any country. So why keep all your eggs in that one basket that can lead you to ruin? You have to create a insurance plan. You have to create a safety plan, especially as you're getting older. Maybe it's for me and not for you youngsters, but anyhow, these were my thoughts, and I wanted to share those with you. Please do share these videos with your friends and family, and spread this word around about daily bytes. I would like if more and more people can listen to this and maybe take some benefit out of it. Thank you so much. Bye.